Most people overpay their taxes. As a business owner, it's 93% of the time based upon our surveys over the last 10 years. I think it's gone up, and we're doing a new survey this year. I think it's probably 100%. Win and play, the way that I did it with Killing Sacred Cows is I pre-sold 22,000 books before the book was released. Now, I did it by creating value up front and telling people, this is back in the day where there were DVDs. I give people a DVD on it. We did an 8-week teleseminar series, so we gave them all this value up front, but now we pre-sold the book so that when I was writing it, I was actually writing it for someone. And I was getting feedback from those readers along the way that pre-purchased the book, and then all of a sudden we hit the ground running where we hit New York Times, and then it got more distribution because of that. Like, it was a win-then-play strategy. The very first time I ever put out a video series, I went to all of our existing fans and subscribers and said, hey, we're into a video series, but before we film the first video, we'd like to share with you an outline. We'd love to get your feedback, and if you're willing to invest right now, we'll give it to you at 50% of what we're going to charge when it's completed for a couple of reasons. One, because you don't get it up front. You have to wait for it to be completed. Number two, we want your feedback. So we actually got $150,000 in our accounts before we filmed the first video. Win, then play. It's a mindset. It's a methodology. It requires integrity. Only people that integrity get to do it. Otherwise, I'm going to have to kick your ass, right? But if you have integrity, it absolutely works. And it's a different way of looking at the world and operating in business where it's value first, it's a value economy. And now let me relate this to finance. So what are some of the ways that you can have win then play in finance? You've heard of like dotting the I's and crossing the T's. Well, let's do that right now because this is one of the ways that you get a lot more money in your life. So to cross the T would be for tax. Most people overpay their taxes. As a business owner, it's 93% of the time based upon our surveys over the last 10 years. I think it's gone up, and we're doing a new survey this year. I think it's probably 100%. Like, it would be rare for someone in the methodologies that we've discovered, which are pretty simple. One, you have to have a team and be proactive with them. If you're not talking to them quarterly, you're probably overpaying tax. If you don't reactively look every 3 years with a different set of eyes to amend, you might be overpaying tax. The second thing is, if you don't have a documentation structure and a tax strategist to tell you how to turn your expenses into tax deductions, you're probably overpaying tax. But the big one is reclassification. Reclassification is the game changer when it comes to tax. Reclassification is how do you move, first of all, active income to passive income. Passive income is taxed at a lower rate than active income. Number two, how do you move ordinary income into capital gains? Capital gains is a lower tax rate than ordinary income. Number three, as a business owner, because you're a business owner, how do you make taxable income become tax-free? That's a possibility as pretty much exclusive to a business owner. And number four, tax arbitrage. Tax arbitrage is anywhere when you spend $1, you get more than $1 of tax credit. And there's a lot of those that are available out there. So once you understand reclassification, deduction strategy, and how to operate with the team, there's more tax savings. And it doesn't matter whether you're from Canada or the United States. We've had Canadians that I don't meet with them. I don't help them with their taxes. I teach them the format. And one guy that's a health guy here in Toronto, what's his name? Bald guy, played soccer. No, yeah. Do we save Sachin money? Yuri. Yeah, we saved Yuri $100,000, you know, and he's a Canadian. I don't even know what the hell the Canadian tax laws are, but we saved him $100,000 because I taught him the format. So once you know that, you can get a lot more money. And think about the win then play. If you save tax, Mike, did we save you tax?
Yeah, it paid for the whole entire program for the year.
Cool. So we saved Mike tax. That was a win, right? Like right now, and you're going to save that next year as well. So imagine if to save that amount of money, how much money do you have to set aside and take risk and invest to eventually create that cash flow, where if you have financial intelligence and savvy, you get the money now. That's a win then play. It's an immediate guaranteed bottom line return. So now to the I's. The next I is interest. So ways that you become more efficient, you capture money, you put more money in your pocket, you boost your bottom line, you don't have to work harder, yet you have more money. It's how you structure your loans. It's having the right credit score, or the right collateral, or the right cash flow reporting, or the right connections to actually save you interest. So one of the ways that people can save interest is if you have any underperforming assets, like a certificate of deposit, or a money market, or funds in the market right now, like anything where you're earning a lower interest rate than you're paying on the loans that you have, cash it out and pay it off. It's a guaranteed return. That's really simple and basic, but I got to tell you, until we give people permission, we find that most people have that situation and don't take advantage of it. Or let's say you have a credit card. You could always refinance a car, get a 1.9 or 2.9% interest rate, and pay off a credit card that's usually a lot higher than that. And by the way, a car loan improves your credit score. A credit card lowers your credit score. When you improve your credit score, you could renegotiate other interest rates. All loans you have are negotiable. So I can go off on that for hours, but I'm just giving you a sense that there's money there for you if you know how to structure it, and if you know how to really operate properly with that. You can keep a lot more of what you make or pay those things off with a lot less effort, or with the same dollars, shave off a bunch of time on it. Next I is investments. And investments are so damn misleading because we use percentages instead of using actual numbers. Like in percentages, it doesn't sound like a big deal. Like if I had 100 grand and I could earn 10% for 30 years, which is practically impossible to get it 10% every single year, but they like to show it that way sometimes, and that's what they can legally show. That 100 grand grows to 1.74 million at 10%. But let's say you have legal fees, admin fees, 12B1 fees, which are marketing fees that you pay the fund companies, or other kind of 401k, RSP, whatever it might be, fees that are coming out, and it's less than 1%. It's 0.8%. So now you're earning 9.2%. That same 100 grand at 9.2% grows to 1.4 million. That's $340,000 out of your life unnecessarily. Non-performing fees, hidden commissions. Once you detect it, you can remove it, and you can keep all that money. The second thing is making sure you're protecting your downside when it comes to investments. At what point when the market goes down does your mindset follow it? That's the time that you create a minimum liquidity event called a trailing stop loss. So if the market goes down by a certain spot, you actually move to cash and you don't have to follow it all the way down. Or if you loan someone money, you get a personal guarantee. Or if it's for a business, a UCC filing where you can attach to their cash flows. Or collateral like a bank would have. I mean, banks are pretty brilliant at this when they follow their own rules. Anyone got a mortgage recently? You got to give, I think now they look at your blood too, but and your stool samples, that's the weird one. But ultimately they're going, hey, we need to see an appraisal on the property. That's not for you, that's for them. You've already decided you own the property. If you don't put down enough down payment, you have PMI, private mortgage insurance. That's to insure and protect them. You have your credit score that they look at. You have your cash flow reporting and taxes. They're doing all this to mitigate and manage risk. The question is, how are you mitigating and managing your risk when it comes to your investments? Not doing it is playing to win, and it's very loose. Other people get so extreme with it that they only have cash and they don't even allocate it anywhere any other time. That's playing not to lose. Win then play would be, you know what it is, you take care of it, you don't participate in the whole downside, and you protect the money. Now, the last I is interest. There's just duplicate coverages, improper structure, and let me just give you a simple philosophy. The philosophy is insure the catastrophic, never the inconsequential. Your most expensive insurance is the insurance you're highest likely to use, but it's not going to harm you. So what I mean by inconsequential is this. You can sleep at night and write a check for cash to handle any of the incidents. That's inconsequential. Meaning, if I knew I had to pay $1,000 for a fender bender, I'm not losing sleep over it, and I can write a check for it. Now, if I had a lawsuit for $1 million, I'm losing sleep over it, and I sure as hell don't want to write a check for it. So that's more catastrophic. The last dollar you insure is the least expensive, yet most critical. Right? The last dollar, meaning that last highest amount that's being covered. Don't cover the small things, cover the big things. It's going to save you money. It's going to help you transfer risk. So save on tax, save on interest, save on non-performing investment fees, hidden commissions, and the drag on your money, and then save on insurance without sacrificing coverage. If you do that, that's win then play. It's money in your life, money in your pocket. $2,484 per month is the improvement on cash flow optimization within one of those structures. The average tax savings is $11,470 per $500,000 of revenue. Like, it's actual cash going to the bottom line. Not revenue that you then pay employees or overhead. It's just spendable dollars.